Happy Easter weekend, and we are gonna discuss on this beautiful weekend all across the world, across Europe, across Australia, New Zealand, Canada, United States. We are gonna discuss the most strategic issue of our time. It is not Iran, it is not global politics, it is a simple question. Are we in a giant AI bubble, and is all our investments and portfolios, are they all at risk? Or are we actually looking at a beautiful, bright future, at least financially, and we are all safe? That is the big question. And if you listen to the media and you read what's in the headlines, you will think everyone is very sure we are in a giant bubble, because there is so much expenditure, so much CapEx being invested in NVDA chips, in AMD, in Broadcom, in the build out of the hyperscalers. And there is on and on and on articles and reports in the media that there is a bubble. Look at this. Time magazine, for example, the AI business bubble. At the core of the AI bubble is a basic math problem. Really. Let's read. There is a fundamental mismatch between the trillions being invested. It's actually 670 billion, but fine. Invested into the infrastructure to develop AI, and the billions people and companies are spending to use AI. Specifically, JP Morgan Chase analysts anticipate $5 trillion of spending on AI infrastructure between now and 2030. Me too, by the way. A little bit more. This year alone, 4 tech companies, Amazon, Alphabet, Meta, and Microsoft, have plans to invest $670 billion on AI infrastructure. When measured as a percentage of the US GDP, this is more than the Apollo space program, obviously, the US interstate highway, blah, blah, blah. Yet OpenAI and Anthropic have annualized revenues of about 25 billion and 19 billion respectively. Unless AI revenues grow by orders of magnitude soon, there's a Grand Canyon-sized gap that will be hard to cross. Notably, this overinvestment is being funded by the public. Big tech companies are spending their cash using capital from equity investments, issuing a record level of corporate bonds, and leveraging private credit. The size of the required investments means that nearly every financial market is involved. Well, of course, it's the public. Who else would, if they mean by the public, capital markets? Yes, they're involved and they're funding it. And these news go on and on and on. But when you ask the smart people, not Time Magazine, and you look, for example, at Polymarket, will AI bubble burst by December 31st this year? 16% say yes. That means 84% say no. I believe in Polymarket. I believe in these betting markets. There are lots of smart people there, and they put their money at stake. So why is Polymarket saying no bubble bursting, probably also not next year, probably never? And why are all the dummies in the media saying, oh, there's a giant bubble? Well, as we just saw here in this Time Magazine article, they're talking about the bubble because they're saying, look, we spent so much money, it's so hard to understand, it's trillions. But at the same time, OpenAI and Anthropic only make, 10 billion or something each. And that's not enough to pay for a trillion, right? So we today are going to look at a little model that I developed to actually look through what's going on. It's a very simple model, but it will reveal something that is incredibly important. You know that we in Pioneer Land and Pioneer Alpha are good and focused and specialized in quantifying the world and the future, because we're building a world model that allows us to see the future, not through a crystal ball, but through Google Sheets. In that we put smart things, a little bit supported by AI. So this is just a little exercise here to just give us a feel for what is actually going on. Now, let's look at this. Here you see the CapEx, 670 billion in trillion. So I just did this very quickly, but this is like in trillion USD. Okay? When you look at CapEx, you have to understand a simple thing. There's a certain payback time you need for that CapEx to break even. That is this whole model. And I'm going to go through this to understand, is it rational that the hyperscalers buy so much Blackwell and NVIDIA chips? Is it rational that Tesla is building a terafab? Is it rational that SpaceX is going to space to actually build space AI compute out? And is it rational that people actually want NVIDIA chips and NVIDIA stock? And is it therefore irrational that Tesla, NVIDIA, and other AI stocks are right now crashing because of tactical Iran issues? When it comes to CapEx, when you're spending 670 billion of the hyperscalers, they make the majority, of course, the vast majority of spending in the United States, you need to get your money back. This is payback years. What is payback years? The number of years you want to get your money back. 5 years is good. That is basically the CapEx depreciation. If you buy a chip, You depreciate that over 5 years, which implies you want to be paid back within 5 years. Margin, we assume 60% margin. That's very important. Now, based on that, we can basically derive this little thing. Here is the break even. X, it's actually not ROI, it's break even to be more accurate. Let's put in CapEx break even. Here you see the important number. And I'm not going to bore you too long. I will make it very quick. The required 5-year average revenue. What do you need? 220 billion a year. Okay. So the people who spend 670 billion this year, Amazon, Google, and so on, Microsoft, they need to make in average 220 billion over the next 5 years in average revenue back from this investment. Okay. Of course, then they continue spending. We will go into that, and then they need more and more back, right? But here you see roughly what it is. And the model is very simplified, right? You have to add this all up and so on and so forth. And what I did here is very simple. I compared it to the projected AI value generated over the next 5 years. And then I calculated what is the percentage of value that these hyperscalers have to actually capture to get to that number, to get to 220 billion in average over the next 5 years. And as you can see, it's surprising. It's very low. In my model, if the hyperscalers only capture 15% of the money generated and spent on the AI, they are actually delivering to the market. They're only getting 15% of that over the next 5 years on average. They will break even. And I can tell you, they're not getting 15% right now. They're probably getting over 100% right now because this is venture funded. And they're actually getting a lot of money back. So they're vastly in the green. But of course, you can ask, Joe, where does this number come from? 1.4 trillion average AI value. Well, very simple. Now we have to go into the key aspect of this model. How did I even compute this? You have total labor spent. This is all in trillion USD, right? The total amount of value spent on labor in the Western world. This is the Western world, which means Europe, United States, Canada, and so on. Australia, New Zealand. $30 trillion a year is being spent on labor. That is the Western hemisphere sphere labor expense without China, without Japan, and so on and so forth. 30 trillion. I'm only focusing on the West. That gives China a good chunk of the market. 30 trillion spent. Now the AI replacement share is the share of labor that is being replaced by AI. Of course, that's at the core of our models here, where we are building out the AI trajectory and the AGI trajectory. With most of the verticals that make up human labor, the markets, right, healthcare, so on, financial professional services, and so on. We estimate that AGI will reach 100%, meaning beating the median human across the board in nearly all of these areas in 2027, in early 2027, some of them even late 2026, like coding. Okay. So, and then there's a lag in implementation, but not much of a lag. So we are assuming, here's the assumption, 1% of these 30 trillion will actually be replaced in 2026. Okay. I think that's a safe assumption because look at the explosion of AI applications. Look at the coding. Look at all kinds of stuff. The fact, by the way, that AI replaces that amount doesn't mean it's actually replacement. It means it captures that amount of value. We are not talking about if the humans find new jobs, if the labor market is expanding rapidly, right? You know the paradigm, Jevon's paradigm, that we actually consume more labor if it becomes more cheap. And then there's an AI share additive. So basically I'm saying if AI replaces 1% of the human labor, it also adds another 2% in AI usage because of Jevon's paradox, right? So basically I'm assuming in addition to that, so here's the 200%, for every job AI replaces, it also adds 2 more jobs that it also replaces. Okay, what does it mean? It means if you have 10 marketing people on your team and AI replaces 1, you're also paying for 2 more AIs because it's so awesome. And of course, the underlying assumption here is that is that this AI laborer that replaces your laborer costs only 10% of the human. So you're getting 100% human replacement for 10% of the cost, and that is, of course, the big driver. And that is why if you replace one person in your team with an AI agent and pay the AI agent 10%, you're also buying 2 additional AI agents without replacing more humans. So that is that rate, the AI labor additive, and that means 1% replaced, 2% added, 3% in total. And here, this is being multiplied then simply with the 10% labor cost, right? So you're basically now adding, or AI eats up 3% of this 30 trillion, but only gets 0.3% because it costs only 10%. That is the revenue generated. And then we do the math, right? Because this line here is basically the full replacement, and the line below is the line that tells you how much is added. And then below that, you see the trillions added in AI value, total AI value share, right? So this, in short, is the model. So we're adding roughly $1 trillion, right? Or AI value share is $1 trillion, not the added. That's the old equivalent. Then of that, it's actually not $1 trillion, it's a little less. I have to add one decimal point here. Let me do this very quickly. So it's not $1 trillion, it's 900 billion roughly, see? And then 10%, this is the actual money generated. This is the actual economic revenue-based value generated. That is the revenue these AI agents that are now replacing the humans are adding, right? $90 billion in AI spent on the actual agent level, okay? That is what we are seeing here. But next year, in 2027, because of that growth, 5% of jobs will be replaced. Maybe you think I'm crazy. Maybe you think, Joe, we are not replacing 5% of human labor. Believe me, we will. Then we are replacing 10%, 20%, 40% by 2030. That's pretty conservative. That's still not even all white collar jobs. So I'm being very conservative here. Here we are assuming the robots kick in 2033 and 34, and then we are getting very high, right? I think the most important number is not even that one. It's the total added jobs. I think here I'm being way too conservative. Companies are not going to spend only 2x on each human replaced, right? So one agent replaced one human, you're adding 2 more agents. I think that number is wrong. Maybe my replacement share in the end in 2033, 2034 is too high. It levels out at 90% because you could argue there are a bunch of humans that are hard to replace. Let's see about that. But sure, maybe I'm too high here, but I'm definitely too low here. So the bottom line is the AI value share number, the trillions of dollars generated down here from actually AI agents. That is the number that matters, because that number, this number here, in trillions of dollars, 500 billion next year, roughly $1 trillion in 2028, 2 trillion in 2029, 3.9 trillion in 2030, 6 trillion in 2031, 8 trillion in 2032, 9 trillion, nearly 10 trillion in 2034. That is the cash spent on AI agents, okay? Based on a simple assumption that you pay 10% of human wages to your AI agent, right? Multiplied with the capability, you get to this. This is my projection of the actual AI endpoint revenue coming into the space. And that number, 90 billion this year, 500 billion next year, 1 trillion the year after, I think conservative numbers based on what is going to happen. That number determines how much money is generated through the AI agents. And that number down here then tells you what is the percent the hyperscalers, the people who buy the NVDA chips, actually have to make in order to break even. These numbers are extremely low. These are extremely easy to hit. So why do we have the bubble talk? We have the bubble talk because people do not do the math, number one. I mean, we are talking about Time magazine. They probably don't even know how to spell math. Okay, so these people are not very good at math. It's very sad. Right? They don't know how this works. We have other geniuses like Joseph Stiglitz. He's also not the best in predicting anything. He's also saying, ooh, overinvestment, AI bubble. Stiglitz is not known to be a very savvy businessman who can predict the future. If I'm right and there is a bubble, Stiglitz won. Well, you're not right, Stiglitz. Then the breaking of any bubble is really bad in the short term for the macroeconomy. Sure. So this entire discussion basically evolves around, first of all, the model that they don't have. They have to understand this model, right? If you have the CapEx, you need average 5-year revenue coming in. This 5-year revenue comes from other people spending on AI, your customers. If you're Amazon, if you're Google, if you're Microsoft, you're buying from NVIDIA. Then you're deploying your hyperscale super AI factories, and other people, the agent owners, Lovable, Cursor, these kinds of people, Anthropic, OpenAI, they are buying from you, right? And then they're keeping the difference because they're selling their products into the actual value generating end chain. And here's exactly how much they have to pay you. So if OpenAI or some endpoint agent provider, Lovable, Cursor, OpenClaw people like OpenAI, or Anthropic, Claude Code or whatever, if they make $100, all they need to pay to Amazon or Microsoft is $15 of the 100 and then $11 and then $10. It goes down the percentage because this goes up so much in order for them to break even. And then you understand. Now you understand why the CapEx of Tesla in chip manufacturing, the CapEx of NVDA is very justified because the hyperscaler CapEx is very justified because the enormous amounts of money and effort poured into the agent systems that actually replace jobs is super justified. Now we know why. As long as this line holds up, as long as this is the replacement rate and this is the multiplier, we are golden. The replacement rate will be probably a little lower in the 30s and the multiplier will definitely be higher. So we should be golden. And that means that CapEx over here, look at this CapEx. They said 5 trillion by 2030. I'm estimating a little bit more. We can do quick math. How much is this actually? Where's my sum number here? Sum. Bing, bing, bing. And you see that my number is much higher than 5 trillion. It is 7.3 trillion. I'm saying 7.3 trillion. JP Morgan says 5 trillion. Not bad, JP Morgan, by the way. And then these little dummies, they say this is way too much, 5 trillion. Well, I'm saying 7 trillion is definitely not too much because they're going to drown in money. We're going to drown in AI agents. We're going to drown in extreme capability. Sure, we might get killed by these agents, but that's another story, not for Easter. For now, we just know if we invest in this stuff, we're probably going to get rich. So I hope that was helpful. This is my first little model here. I developed half of it while we were talking. I did this in probably 20 minutes before because I find it fun and I think it's going to be very helpful. We're going to discuss this model in the Pioneer Academy. Go to pioneeracademy.com or pioneerlens.org. We're building these models out and we are building what I call the control room for reality engineering, where we predict the entire world based on some KPIs around robots, AGI, autonomous transport, space AI, AI blockchain, very important, didn't touch on it today, and of course macro. And this predictive model that we are building helps me to do a little portfolio management for Pioneer Alpha, helps all our members to do their own stock assessments, and ultimately lead us to creating an AI economy, an economy that actually works for everyone, at least for everyone in Pioneer Lens, because the rest is unfortunately clueless. But fortunately, you're not clueless because you watched this video. I hope this was interesting. Beautiful, happy Easter, and see you tomorrow.